All right, hello. Welcome to this week's MoneyFit Live by DRS. My name is Todd Christensen. I am Education Manager at MoneyFit, and today's topic is young and financially empowered. We are going to be addressing topics that are may seem general to the entire population, but very specific issues that are challenging our 20-something population. So if you have, as I put in the chat, if you have any comments or questions, please feel free to chat with us. And at the end of the webinar, I'll leave some time for Q&A. I will also provide a link where you can get your certificate of completion. There'll be a required passcode I'll provide at the end of the course as well. So let's go ahead and get started. We're going to talk about danger signs here and of financial troubles coming down the road. How do you know when there might be something happening? And I saw this GIF and I just couldn't help it. Sometimes danger signs are obvious to everyone but ourselves. We might be so focused on our own finances or on our own goals or our own lives that we don't notice that there is a sign, a glaring sign right there telling us we need to be aware that there's danger coming. Sometimes the sign itself will turn into something that'll damage our own finances. So let's. What we're going to do is we're going to go through some of the ideas of good debt, bad debt, because debt is one of the biggest issues, challenges that 20-something crowd is facing. Let me talk about some of those signs. One, if you're having trouble, if you have student loan and you're having trouble making your standard payment, it's the standard term is 10-year is a 10-year repayment term. If you are struggling with that, that's a sign that there's some attention need to be paid to your finances, whether it's income or other expenses. If your car payment and plus insurance plus gasoline plus maintenance comes into in the range of 15% or more of your income, that might be a sign that you're over leveraged on your car. It might work for some people, but if you're struggling to pay normal bills, looking at the size of your car payment might be something to consider. Carrying a balance from month to month on your credit card. A lot of people think that's just normal and that's what everybody does. It is not what everybody does. It is what those people who are in debt do. About roughly one third of credit card holders pay off their entire debt every single month, which is the goal for everybody. Another 1/3 makes only the minimum payment of their credit card debt, and then the remaining 1/3 is somewhere in between. They don't pay it all off, but they pay a little more than or much more than their minimum payments. But 2/3, that's basically 2/3 of credit card holders are paying interest on their debts. If you've ever gone over the limit on your credit card, or if you've had a purchase declined because of the limit, those are all signs, general signs that there are some problems that you might need to address in your finances. These are things that our 20-something crowd, they're fairly generally new to credit card, and if you're wondering if that's normal to carry balance, it should not ever be considered normal. Paying off your credit card debt should be your number one priority when it comes to your finances. If you struggle from month to month paying off that credit card debt, then it's probably time to not use it and to switch to cash or a debit card. Other issues you might be aware of some of these danger signs. Do you know what your credit card interest rate is? If you don't, you need to take a look at it. There's some people that are unpleasantly surprised when they take a look at their credit card interest rate that it might be in the 20% range or higher. The average credit card interest rate over the last 10 years has been somewhere between about 14 and 17%. It's actually As of this recording, it's actually pretty high in the 17% range historically. But that's, if you have high interest rate, that's a sign. If you that you're overpaying for anything you're buying, you're adding interest to the purchase. If you don't regularly balance your checking account, even if you're a debit card user, if you depend completely on whatever your bank account says on your phone, there's some potential danger. You need to make sure that all your purchases and all of your bills are being paid on time, that maybe a utility bill is supposed to come out yesterday and it's not, maybe it's delayed for a few days. You're thinking it's been paid because you're just assuming it always comes out on this day of the month, and you're looking at your checking account balance on your phone and it says here it is, and so you think you have more money to spend than you actually do. So lots of different signs to look for that could be troublesome and indicate that coming down the road you're going to get hit by something even bigger. So let's go through some of the different debts, good debts, bad debts, and see if any of these are things that you're aware of already. Traditionally, good debt, bad debt has been around for generations. Traditionally, people have thought, oh, home, business, student loan, all good debt. I'm not really a fan of that paradigm. We're going to actually talk about potentially beneficial debt, practical debt, and bad debt. So let's look at what is good debt. Are you building a home that is just going to come crashing down? This was, again, another video I thought just appropriate. If we get into too much debt, it only takes a little bit to push us over the top and the whole thing comes crumbling down. So the first one is the home. Let's talk about this home loan. The idea of home being good debt. A lot of people back in the Great Recession assumed that any home loan was good debt. As we learned, as too many people learned, you can get into a loan that's far too big for your finances, for your household. Even if it's tied to a home, that does not mean it's guaranteed to be good debt. As long as you can afford the payment and all your other finances, all your other bills are being paid, here's the potentially beneficial, and it's highly likely to be beneficial, but it's not guaranteed. Most homes appreciate in value. They go up in value over time, but there's no guarantee for that. Yes, we had the Great Recession where home prices pretty much went from late 2005, 2006, within about a year, about 2-3 years, plummeted to about half their high value. But that's because for the years that 2003, 2002, up to about 2005, 2006, home values were skyrocketing. On average, they're going to go up about the same as inflation, about 3 to 4% in that range. And so over time, unless you get in at the top of one of those super hot markets, you can pretty much expect your home value to continue to rise about 3 to 4% a year over a long period of time. So it's generally considered potentially good debt. Here's one that when I go into high schools, I get this one a lot. A lot of kids assume that because it's a large purchase, it must be a good debt. They just think, hey, I got something big and that's a value, it must be good debt. That is not the definition of good debt. Good debt is something that will bring you value, greater value than the debt that you went into. So the home goes up in value. Pretty much by the end of a 30-year home loan, the home will be worth about what you put into it plus all the interest and the insurance and other things. And so it's not a great investment, but if you look at it compared to renting, it's a fantastic financial move. Buying a car is the opposite. You buy a car, and let's say you buy a $20,000 car, within a year, that car is going to be worth $15,000. And within 5 years or 6 years, by the time you pay it off, if you're getting a loan, that car will be worth less than half, quite often, of what you paid for it. And so you are not getting back the amount of money you put into it. So it's generally considered bad debt. The only time I think you can consider a car loan as potentially beneficial debt is if you say there is no other way I can get to a certain job that is going to bring me much higher income than what I'm at now. So if you need a vehicle, you can't take public transportation, you can't walk, you can't ride your bike, so forth, and you need a vehicle, and the only way to get that vehicle is a loan, and you're going to get to a job that's going to pay you a lot more than what you are earning now, then potentially that's beneficial. But generally, car loans are not things that we should consider getting into, if at all possible. And this is the problem with 20-somethings, is that we just assume, oh, mom or dad had a car loan, or I see on TV everybody talks about being in debt and making car payments. It must be the norm. It should not be the norm. So don't think of it as it's inevitable. Start small. Start with buying a car that really you don't need to impress anybody. Just get you to and from work and from other activities. If you go right for the big car, you're going to end up shooting yourself in the foot in the long term, because that means that a lot of your money income is not going to be available for other bills. Student loans. This is one that we just assume is going to be good debt. It's got to be good debt because it's going to increase my income. Yes, on average, a bachelor's degree will pretty much double your income versus a high school diploma over your lifetime. Problem is, not all excuse me, not all degrees are created equal. You go to one school and look at all the different degrees. Most of those degrees are going to be fairly similar in cost. Some of them will have additional fees, and if you start looking at graduate schools, then those are going to vary within schools. But a bachelor's degree from one department to another are quite often going to be very similar, and because the tuition is pretty standard. But the honest truth is that an engineering degree is going to get you probably twice, coming right out of school, is going to get you probably twice the annual income as if you had a degree in early childhood education. Not to discount the value of that, but financially it's very different. So just because you say I'm going to get a degree doesn't mean you should go and max out every student loan you can get. Here's the rule of thumb. Do not get more student loan debt than what you will earn your first year out of college realistically. Don't look at averages for that industry, because if you look at average income for the industry, it usually takes into account people who have been working for 20, 30 years in the industry and have a lot of experience. But do some research and find out, what can I realistically expect to earn my first year out of college, and avoid going into more debt than what that is. Otherwise, you're going to struggle to pay off that debt in the standard 10-year term, and maybe even in the extended 15 or even 20-year terms. It's just better to minimize the debt. I have a whole nother presentation just on student loan debt. What about credit card debt? Isn't credit card debt just to be considered bad debt? Most of the time, yes. If you pay off your debt, credit card debt, every single month in full, on time, and are not hit with any interest fees, there are times when it might be considered practical debt. If you go on vacation or traveling, it's probably better to use a credit card than to take a lot of cash, that if you lose it, you're in a lot of trouble and stranded. Whereas if you take a credit card and you lose it, you're still not out any of your own money. It's the credit card company's. Even if it gets used fraudulently and you report it as lost, it's the credit card company's money. So as long as you pay it off in full by the next paycheck, by the next due date. Understand this though, but using a credit card, using a debit card, using a prepaid card, it doesn't matter. Using plastic, you will spend about 15% more than if you were to use just cash. So credit cards can be practical, but they're going to be more expensive because you're going to spend more, or you're just going to incur interest fees. Here's the third traditionally good debt would be a business loan. But here's the thing: if you just say, well, business loan is good debt, Understand, most small business owners, when you get that first business loan, you are guaranteeing that loan with your own personal credit. You're responsible for it, not as a business, but quite often as an individual. So if the business goes out of business, which many do, you're still going to have to pay for that loan. It is part of your personal responsibility. So understanding that business loans are high-risk loans, because so many do fail early on, you're going to have to first make the case to the lender why it's a good idea to lend you money, but you're also promising to pay it back even if that business is no longer around. So it's potentially beneficial, because if your business does take off, it could be a fantastic way to earn a really comfortable living and do something that hopefully you really enjoy. But everything else consider everything else bad debt. They're just, unless it's going to increase your income potential, it's going to be bad debt. There's other ways to get through it. Okay, what are the potential negative outcomes? In some of the classroom programs that I do, I'll give them a handout and have all these different things listed on the and I'll ask them circle all the different things that could happen if you don't pay your bills. And some of them will just put a big circle around the whole thing, thinking that everything bad can happen if you don't pay your bills. Generally, not paying bills can lead to a lot of terrible things. It can lead to, of course, higher interest car insurance, because most car insurance policies are based, at least partially, on your credit rating. So if you're not paying your debts, your credit rating goes down, your insurance rate goes up. Higher interest rates, of course, being denied an apartment, because a lot of property owners are going to ask for to look at your credit before you can move into an apartment on your own. So this is a reason why you want to make sure you're protecting your credit and building it. And there are ways to do that responsibly. Join us for another MoneyFit Live here in another few weeks to talk about that, or go to moneyfit.org/academy and you'll find a credit basic course there. Understand this: if you don't pay your student loan debt, does not necessarily mean you're going to be kicked out of college. It will mean that if you've been out of college for a few months and are now in repayment period and you're not paying it on time, you're not going to be able to qualify for new loans. Work with a lot of people who are trying to deal with that they want to get back into college. Maybe they took off a few semesters and are supposed to be paying it back, but are late on that payment. You're not going to be able to qualify for new student loans until you get caught up, or until you get on a plan that that you can afford. But of all of those, most of those are things that probably would happen eventually. Here's some of the things that might happen. You could actually lose a job depending on the type of industry you're in. You could go to jail. We don't have debtor's prison, but if you're not paying your debts, there are certain places in this country, certain states, where right now, at least in Texas, Florida, and a few other places, where if you, for example, take out a rent-to-own and you don't pay it on time, they don't just consider that missing out on a debt, because it's not technically a debt. They consider that basically stealing, and you could be arrested if you don't pay it on time or return the property as agreed. So make sure you're paying all your payments, all your debts, and all your responsibilities on time. Poor health actually could be a result because of the stress. Generally, having your TV repossessed is not going to happen. Even if you charge up your credit cards to an insane amount, buying huge TVs and electronics, credit card company's not going to come and take it away from you. So let's just talk very briefly about getting out of debt, and then we'll open this up here in a couple of minutes to opportunities or questions you might have. So what are your options for getting out of debt? First of all, make sure that you stop the slide into more debt. You can't get out of debt if you're still going into further debt every month. That means you got to figure out a way to stop using credit cards. Cut them up, or do not carry them. Certainly stop carrying them in your purse or wallet. If you're struggling to pay even living expenses, you're out on your own and you're using a credit card just to survive by paying groceries, eventually every month, because of the interest you're paying, the debt gets higher and higher. You can buy less and less of your groceries, so you've got to stop using credit card to go into further debt. So get off the slide. Number 2, create and live by a spending plan. This is also known as a budget, but don't, if you hate that word, call it a spending plan. It is really just how are you going to spend your money? Are you going to pay? How much are you going to pay for your groceries? How and when are you going to pay for your rent? It's just a plan on how you're going to spend your money. It gives you kind of permission. Calling it a spending plan gives you permission to spend money. You've just got to tell yourself, this is how I'm going to spend it this month. So that's make sure you live by a budget. You may have to modify your spending behaviors and your habits. Again, you might have to get rid of your credit card, even a debit card. As I mentioned, if you're using a debit card for everything, start using cash, and you will all of a sudden come up with typically about 10% more cash available to make your purchases. Need to look for ways to minimize impulse spending. Don't take plastic into a consumer situation, into a store, even into groceries. You'll save money. And look for ways to avoid sale spending. Just because it's on sale doesn't mean that it's affordable. Yeah, they say it's 50% off, but who's to say what the original price was? You have to know what you can afford, not what the marketers will tell you that you should buy just because it's a good deal. All right, another option, look at understand what your choices are when it comes to getting out of debt. Really briefly, there's paying it off as agreed. There is, so you get on the right repayment plan with your creditor. If you can't pay what they are asking you, contact them directly. Ask them for hardship programs or maybe a repayment plan that you can afford. Look at talking to a credit counseling agency. Look at, that would be your first stop if you can't pay it off on your own. Go to a credit counseling agency who will work with your creditors to lower your interest rates and set up monthly payments you can't afford. If that doesn't work, kind of the last option might be bankruptcy. Bankruptcy is a legal process, and we have worked with people since the bankruptcy law changed way back in 2005 who need to come through a credit counseling agency even before they can file bankruptcy. So go see a credit counseling agency first before you start talking about bankruptcy, because there are options that might help you avoid that. It's there for a reason, though. It's never a pleasant situation to go through. You have to go through federal court to do it. It does cost money. You have to have extraordinarily low income in the poverty range in order to waive the filing fees, but attorneys generally do not waive filing fees. You're going to have to come up with a couple $1,000s quite often to even work with an attorney. So it's expensive to file bankruptcy, ironically. Understand this, last few things. When you are in debt, or when you're thinking about debt, avoid these debts at all costs. When you're young, you might just think debt is debt. It is not. There are a lot of debts that are way more expensive than others. Credit card debt you might think is the worst, but it's not. Yeah, 17% I mentioned is pretty common right now. But if you're overdrafting your checking, quite often those overdraft programs are going to be charging you fees that would equate to about 10 to even 100% annual interest. I prefer not to be on overdraft. It's much more affordable just to get an account or a purchase decline than it is to have to pay back all those fees. Cash advances on your credit card. If you get a PIN with your credit card, you can actually get cash at an ATM, but that typically is going to be 20 to 30% interest. If you go down to a corner finance store, pretty much what you consider a strip mall, a finance company, if it says finance on it, finance company, those are I call them corner finance companies. They're going to be anywhere from 20 to 50% annual interest, pretty high. Pawn loans, 50 to 100% interest. You can look at, and let's just go through that. Yeah, overdraft is the 10%. Credit cards, 14 to 17%. The cash advance is 20 to 30%. That corner finance, 20 to 50%. Your pawn, as I mentioned, 50 to 100%. What if you're getting your taxes done and they offer you a tax refund? Understand that refund If they want to give you a loan on that refund, and so you don't have to wait the 2 weeks, 3 weeks, it's going to equate to about 50 to 500% annual income. If you go with what's called a car title loan, and some states do not allow this, it's illegal, but you can get a loan against the value of your car if you own it completely. It's going to be about 100 to 200% annualized interest. Start talking about rent-to-own contracts. These are not technically debts, but people think of them as debts. You're going to end up paying 100 to 500% more for that item than you would if you just bought it outright. And that doesn't mean, so think about it this way. You get it paid off after a year or after 2 years, you could have had 2 or 3 or 4 of those items, or even 5 of them, for the same cost. You could have 3 large screen TVs in your room, in your home, rather than just one. And then, of course, the granddaddy of them all, the payday loans, which work out to be 400 to maybe even 800% or more. So let's just finish up here. Here are the consequences. If you ignore fees, you might end up in a lawsuit. Or ignore payments, you can end up in a lawsuit, have a lot of fees, maybe even have your wages garnished. If you pay as agreed, you're debt-free. Get out of debt as soon as you can. Go with the credit counseling agency. You can be debt-free within 5 years or less. There are going to be some capped fees. They're regulated by state, and there are no prepayment penalties. If you go with a settlement, calling your credit card company or using a company to say, hey, can I pay only half of what I owe you, and will you accept that? It's going to ruin your credit, and there is a lot of uncertainty in the future that you might actually end up being sued by another company who has taken over the debt that was forgiven. Plus, you might have to pay taxes on that. And then bankruptcy. You might have to end up in bankruptcy court. Again, bad credit, which means any kind of debt you're going to borrow in the future is going to be pretty expensive. So I want to get through to the end here, and this is just our going through the theory of change and how to picture your future and compare it to how you are now, and are you content with where you are now, and what are you doing to improve the chances. That's the theory of change. You can come back, pause it, look at it a little more. But here's where you would go. I know we're out of time here. Here's where you would go if you want to get your certificate of completion for this course. You'll go to that bit.ly/MFL, that's MoneyFit Live, MFL-20s, and enter in 20-something, and the something is all lowercase. So at this point, I'm happy to open it up for any questions or comments you might have. There is a little delay, I believe, on our broadcast here, so if you are wondering why I'm not reading it immediately, understand that. But do check out all of our resources at moneyfit.org/academy. You'll find links to upcoming live events as well as archives and archives of previous live events, and then other courses that you can take 24/7 at your convenience. I will tell you right now that there are some of the courses we have there would include our Who Wants to Live Like a Millionaire. It's a great course about whether or not lifestyle that you think a millionaire lives is what is true or is reality, or if it's a myth. And if you think it's reality, if that's how you want to live and you try and live that way, how that's going to affect you and your actual chances for living a stable and secure life financially. There's a nice self-evaluation on there. We also have a Credit Basics course that you can read through, and going through quite a few others. Please share this information with those that you care about, family members. If you've got teens, all of our webinars are appropriate for teenagers on up. It is a great opportunity to start learning. If you have family members that are struggling with debt, let them know about our resources, and we're happy to take care of you however we can. So with that, I want to thank you for joining us today, and if you have any questions, reach out to us. Our phone number is there on the bottom, the 800-432-0310. You'll find us at moneyfit.org, and we'll look forward to seeing you again at a future live event.